So what does it mean when we're worried about Greece defaulting, we're worried about the credit spreads in Italy getting wider? We know that this is our major trading partner, Europe. What bearing does this all have on the continent?
Good afternoon, Rata. Well, tough times for Africa. I don't see any reason why we're going to see funds coming back into Africa just yet on an investment basis, on a portfolio basis. Certainly we're seeing a lot of guys switching out back into dollars. They need the dollars back for funding, and they're going to be switching out of all their assets. So we're seeing sell-offs across the board. I mean, I know Kenya's under a lot of pressure through various different reasons, but we're certainly seeing outflow of funds again, and you know, South Africa's untouched as well.
It's an interesting phenomenon when you say that people need their dollars, because when we saw the first tinkerings of problems last year, a lot of investors were looking for yield in emerging market. It doesn't seem like yield is a priority at the moment. Explain that to us.
I think when we had the run on to yield, the guys had a lot of cash on hands, they had dollars on hand, they were looking for yield, and there was no risk aversion in place. I think now we're finding a huge amount of risk aversion in place. We're going to see funds heading out of risky markets. So emerging markets are struggling. African yields are certainly attractive. I think they're probably at levels now that are probably more attractive than they were back then. But there's risk aversion, guys are nervous. You know, it's not about showing a return on your cash just yet. It's about surviving with the cash that you have in hand. So if you've got a lump of dollars, you're going to keep those dollars safe as long as you can. I'm sure when the dust settles in Europe, I'm sure when we see guys across the board in Europe settling down and looking for yield players, they'll be back into Africa. It is attractive. But for right now,
so what are the options then for African authorities? Because if some of our securities are looking a little more attractive, but people are not buying them, should we be using other platforms to try to market African debt, for instance? I know a lot of countries have started exploring the options of Euro bonds. Is this a time to go to that market?
We're certainly seeing interest in Eurobonds, guys looking to invest. I think the Kenyans were talking about 500 million Eurobond issuance. But again, you know, it's one thing going out there. The yields are low and funding will be cheap, and they can certainly raise cash that way. But will people send their money into Africa? Will they take the cash and say, look, here's a Kenyan Eurobond, let's go and buy it? It's a difficult choice for the guys right now. As I said, I think with time, it's certainly going to be there. It's cheap funding for them. So if they can get it right, they're still going to pay up for the money. So you're still going to see those Eurobonds, the African Eurobonds, up at higher yields, and we'll see some investment for there. Hopefully they get it.
For those investors who have hot money, who really want to do something constructive with their cash right now, and yield is not really a priority, what is it that they're going to be doing? What assets are they going to be looking at? Because equities definitely are battered. Bonds could be where they come, but then they have to decide, do they take it to Asia or do they bring it to Africa? Some people are saying, you know, real estate.
Sure, real estate. I think they're going to head their money back into the US Treasuries. I think that's the safe haven status they're going to look at. I think they're going to keep it there. It's safe there. That's where they're going to head back to. And until such time as we see some sort of relaxation in the stress markets in Europe, it's not going to change for them. Are there yields in Africa that are attractive? Certainly there are. South Africa was a beneficiary of that for a long time. We saw a lot of money coming in here, looking for emerging market. It was a safe currency. You could sell the bonds when you needed to. You could get out when you needed to. That's the key issue for the guys. They'll send money where they find their safe markets, where they can get rid of their assets and where they can move the money back out.
And what about the fact that obviously we've seen, I'd say the catchphrases for 2011 are two things, austerity and inflation. And we're starting to feel the pressures of inflation really weighing heavily on us here in Africa. Inflation is also starting to tick up in Europe and the United States, but you're saying that people are prepared to take their money back there, despite everything that's been going on there.
I think that when you look at the G10 currencies, looking at Europe and looking at America, inflation is less of a concern than growth. So the guys they're going to tend to ignore the inflationary concerns and just look at the growth potential in the countries. In Africa's case, growth is a great number out there. I think the guys will, and certainly, you know, as displayed by our bank, we certainly look across Africa as growth potential and a growth area. But when you look at it in inflation, there's concern around inflation. What does that do to the currency? What does it do to the local economies? And it's impacting quite heavily on them.
Why do we seem to not be able to have better coping mechanisms that they have in Europe at the moment already? People are saying they're looking out for whatever comes out of the Fed later on today. They want a proper indication, possibly QE3. We don't have those kinds of issues.
I think in America they're looking at what they call the twist now. I think it's QE 2.5. You know, just in case Ben Bernanke comes out and says something in line with looking at what they can do. But I suppose from an African point of view, what measures do we have in place? And it all comes down to the central banks. It comes down to good governances. I think in a previous interview we mentioned that it comes down to their policy statements. They're clear, precise policy statements. I mean, how do you? I mean, if you hike rates, then you need to look at your repos. When you do your reverse repos, they have to be market-related rates, not a lot lower than what your hiked rate is. So we need to have a clear understanding from what they're doing, and remove any sort of uncertainty from in times of pressure. If we've got uncertainty from the central banks, it certainly impacts on the markets and makes them more nervous and more jittery.